Okay, so chapter 24, we are discussing performance measurement and responsibility accounting, right? And starting on page 994, when we look at responsibility accounting, what are our two primary goals? Assign cost. So the two goals should be to, yes, assign the cost to the managers that were responsible, okay, for controlling those costs. So that's the key reason. In other words, I'm not just going to assign costs. I'm going to assign costs to the person who was responsible for those costs and budgeting for that. And then the second goal is going to be to provide information for the manager to use for what purpose? For performance, evaluation performance, exactly. So this really truthfully only applies to, those companies that are really huge, that have all these different units and departments, right? So you probably won't find that in a little small business that only has maybe one division, mainly for the larger business. So what are we talking about when we say the motivation? What is the motivation behind larger companies separating or segmenting themselves into departments? What do you think the main motivation for that is? Why do I want to departmentalize the company instead of just, I'm sorry? Efficiency, right? Effectiveness, and you want to make sure that it's in smaller segments. You don't want to put one manager over the entire. Something will fall through the cracks, right? So making them a manager over one specific department makes more sense, and you can hold people accountable, more accountable that way if you do it that way. If they're one person over everything, then you can't really hold them accountable for the things that don't happen correctly because they couldn't be everywhere at one time, right? With the department evaluation, you got three centers that you should be concerned about how they're evaluated. You have profit center, cost center, and investment center. Now, cost center, that's when management is evaluated or evaluating based on the ability to control the cost. Okay. With a profit center, that's evaluation based on the ability to generate revenue and make sure that those revenues will exceed expenses, right? Which is always the goal anyway for profit. And then the investment center is going to evaluate the manager based on how they generate a return on the investment into the assets that they have, right? So you need to know those three centers. Controllable versus uncontrollable costs. What do we mean by controllable versus uncontrollable? A cost is controllable based on what? How do you control things? Based on the idea that what?
Like maybe you have a budget or something.
And you're putting that budget in place so that you can control what? The cost, right? How much money you're gonna make. So that's the same thing for a controllable cost. A controllable cost is basically when a manager has some type of power or significant influence over how the amount is incurred. But if you do uncontrollable costs, what does that mean? It's out of the manager's control, right? So it was a cost that just was not expected. It was nothing that they could do about it. So they had to incur it. Okay, examples of that. A controllable cost would be supplies maybe used in that person's department. That's controllable. because a manager can dictate how much supplies is going to be used, right? However, with something uncontrollable, the manager's salary is uncontrollable, right? Not the managers themselves, but if other managers come in, um, the determination of their salary is uncontrollable. Even the managers themselves, their salary is uncontrollable based on what? A lot of managers earn a base salary and what else? Possible bonus, right? Of some type of incentive, and they have no idea what that may or may not be. That's dependent upon the company that they work for, right? Okay, let's talk more about profit centers. So we said profit centers are for the purpose of what?
Generate revenue.
Generate generate revenue that exceeds past what?
The expenses.
The expenses. So if we're looking at profit centers, some things that we need to be concerned about are direct and indirect expenses, right? With direct expenses, that means that those expenses are incurred based on what? Well, we can say production or just, yes, a specific department, right? For the sole benefit of that department. But if it's indirect, what does that mean? In this case, more than one department. So if it's indirect, that just means that those costs are not just stretched over that one division, it's stretched over a couple. Good example. Think about those complex products that take so many multiple things in order for you to sell them, right? Perfect example may be say it again. Printing and labeling. Branding and labeling. Well, yeah, there may be an expense, a different expense. Well, yeah, we can. Let's just go with that. Let's just say you make paper towels, right? You make the paper towels, but you don't make the wrapping that goes around the paper towels. A totally different department makes that. Just like a totally different department may make the tube that goes, in the paper towels. Those are three different departments, and so we can't say that those costs are direct because it's dealing with more than one division. So we have to stretch it out amongst those three that were involved. The good thing about direct expenses are that they can be readily traced, right to that department. But if it's indirect, that might take some time because those expenses may be across the board a couple of different places. So on page 998 and 999, they're just kind of giving you examples of types of indirect expenses. Now, the way that I generalize it is basically look at wages. When you look at wages and salaries, that's an expense, right? How are you going to allocate it? You always have to have a base. There has to be a base for allocation, no matter what the cost, whether direct or indirect. So if it's an indirect expense, something like wages and salaries, what do you think the base is going to be? No, we can't say that we're going to pay managers and pay workers based on the amount of units that they produce. What other base could we use? Yeah, how many hours they work, not necessarily their hourly rate, but the amount of hours they work is going to be the base. What about rent and related expenses? What do you think a base would be for rent? The space that was occupied, right? For instance, if, again, going back to the paper towels example, if paper towels are made in 600 square feet of a 30,000 square foot building, the only thing we can allocate to where the paper towels were made were how much square footage? The 600, right? Because that's where it was made. We cannot allocate allocated over the entire 30,000 square feet. What about advertising expense? What do you think a base for that is? Sales, right? Because that's just their base, their job. You advertise so that you may get sales, so your base has to be sales revenue. What about equipment depreciation? Thank you. Hours used, that asset, how many hours it was used based on the department, right, in which it was used. What about utilities expenses? Consumption, yeah, we can say consumption, we can also say floor space occupied, right? Because again, if you have 600 square feet that is using the majority of the utilities, lights, and all these other things just to make the product, that's probably where you would allocate the most, right? They give you some examples in Exhibit 24.4. Office expenses, their base are employees or sales in each department. Personnel, those are the people that do not make the product. So number of employees will be the base. Payroll expenses, obviously the number of employees in each department. Advertising, we said that was sales. Purchasing costs, dollar amount of purchases or number of purchase orders processed. Cleaning expenses, we're gonna pay the janitors based off of the square footage that they clean. And that is gonna be allocated to what? The departments that use the most. If the production department uses up 50 hours of cleaning every week versus the admin using 10 hours, obviously the majority of the cleaning costs are going to go where? To production, right? Maintenance, same situation. So, departmental income statement. This is something that's relatively new to you. If you turn on 1002 and 1003, they're showing you different sections, right? Different expense statements for each department. Notice that top one, the departments that are included, hardware, housewares, and appliances. Notice all of their bases are what? Square footage. So this clearly is about rent. This is the allocation for rent at the very top of 1002. We already said that rent is based on square footage, right, or floor space occupied. So they're taking all of these different departments and allocating the rent cost based on the amount of square footage that they use. How are they getting the percent of the total? They're taking the department cost and they're dividing it by what? The total cost. So $4,050 divided by the 9,000, right? That's how they're getting the percentage total. And then of course they're taking their 45% and doing what? Multiplying that by what? Total allocated cost. If total allocated cost is 10,800 and multiplying that by 45%, that's going to give them $4,860 that should go towards the rent expense. So it looks to me like hardware is taking up the most square footage and they're paying the most of the $10,800 of rent cost, rent expense. The next one, Exhibit 24.10. This is with utilities. Again, it's based on square footage, floor space occupied. So you have 5 different departments there. Total square footage together is 12,000. How much of that 12,000 goes for general office? 1,500 over 12,000 equals 12.5%. So we're going to take our total utilities cost of 2,400 and multiply that by 12.5% to get an allocated cost of $300. Moving down to Exhibit 24.11. Now we're allocating advertising. What did we say we allocate advertising based upon? Sales. So based on how many sales have come through, that's how we're going to determine what each department, how we allocate those costs. If total advertising costs were $239,000, hardware had sales of $119,500. Divide that by the 239, you're going to get 50%. They sold the most, that means that they incurred the most costs. Moving down to Exhibit 24.12, they're allocating insurance expense. Insurance is being based upon what? The assets that are insured. So how did they determine that? Each one of those departments, they probably looked at the assets that were in those departments and only being used by those departments, and decided that they were going to make that as a basis for how much they need to allocate costs for. And looking at it, the one with the majority of the cost would be hardware. That means that they probably used most of the assets in the business that had a value, that had been insured the most. So we had to allocate it that way. 24.13, they're allocating general office expenses, right? 3 departments, they're basing it on sales. At the top of 1003, 24.14, this is to allocate purchasing expenses. Remember, that's based on what? Purchase orders, right? The number of purchases. In this case, the department with the most purchases was hardware. And so they incur most of the allocated costs for purchasing expenses. Now look at Exhibit 24.14. This is showing income statement that's not new to you. You've seen an income statement before. What you may have not seen before is an income statement based upon department, correct? Okay, so they have broken down hardware department, housewares, and appliances, right? And then they also show you the combined. The combined is what we're used to seeing, right? And so it's important. There are 4 main steps when you're developing a departmental income statement. First step is to look at the accumulating revenues and direct expenses by department. That's 1. Allocate all indirect expenses next. Third, allocating the service department expenses to operating department, and then prepare the statement. So those are the 4 stages or 4 steps in developing this income statement. Let's talk about page 1005, evaluating investment center performance. What's the investment center performance? What's the purpose of that performance? They are evaluated based on what? Isn't it on making sure there is a return on the investments of assets? You remember that from the first page, second page? Okay, so return on investment, the equation is investment center net income divided by investment center average invested assets. So if they're evaluated based on their ability to generate a return on the invested asset, and they use ROI in order to do that, how do we read the results? Because the result is in a percentage, but what can we honestly say about that percentage? For instance, if the ROI was 23%, what can we say about that? Let's just say you were given 2 different ROI figures, maybe 23% and 21%. What can we honestly say about those two different ones? Two different products, two different numbers.
The one generates more.
Which one generates more?
One is 23%.
That's really what it is. And the way that you would express it is that 23%, that particular product earns more dollars of income. Right? Because if you're taking net income and you're dividing it by average invested assets, it can go two ways. One could produce more income, but have less value on the invested asset. And vice versa. One could produce less income, but have more value on invested assets. And who are we to say whether or not which one is better than the other? There's also a such thing as residual income. What are we concerned about when it comes to residual income? What is that going to encourage managers to do with residual income?
To work hard.
Work hard, yes. Say it again. I heard it. To basically reinvest. If you have residual income, you're making residual income, you have money to put towards more investments, whether it be assets or some kind of project or whatever it is, but that equals success in the manufacturing world, okay? What about investment turnover, return on investment, investment turnover? Investment turnover or anything turnover is to make sure that things are being what? Constantly, there is a return on the investments. Not I invest in an asset in 2012 and don't get a return until 2016. That's not good. Turnover means what's the amount of time that I have to get a return on these investments, right? Because the company's money is tied up into that. So that's why you make smart investments and you want to make sure that you're getting not an instant, but at least a timely return so that you can, one, purchase more assets, right? Or fund more investment. And so that you don't lose so much money to where they won't trust you as a manager. As a manager to, invest any of the money. Okay, lastly, balanced scorecard. And then we're going to take the remaining 30 minutes, because I'm letting you out early today, take the remaining 30 minutes to go over some problems. Balanced scorecard. What is your idea of what a balanced scorecard is? This is all you need to know. A balanced scorecard is just a set of performance standards, okay? And it's performance on the company's end, not just specific to a manager, for the company, because there are several different levels of the scorecard. So it's a set of performance standards or measures, okay? So a couple of questions that might be asked. One, how can we continually improve on our value or company value or create value? Next question, how do companies perceive us? How do companies look at how do customers see our company? Third question, what activities do we need to excel in internally? Okay. Last question, how do we look to the owners? Now, mind you, that's a management question, right? Management wants to know the owners of the company are expecting for me to run my department or my division or my unit? How do they see how I'm doing things properly? So what they've given you in your book on page 1008, those 4 questions that I asked, there are some different measures, different processes. For instance, if we're talking about the customers, what do the customers think of us? How do they perceive us, right? You got satisfaction rating. You're a consumer, right? And there are certain things that you purchase and you expect a certain quality of what you purchase, right? You're not just going to go out there and buy a junk car. You're going to make sure that the car is right for you. And what are some things that you evaluate a car with? Gas mileage. What else do you look for in a car? Safety. You guys have cars, I know, right? So what do you look for when you purchase a car? What are some things that you know for a fact are going to satisfy you about a vehicle besides gas mileage and safety? Value, residual value. What else? Some people look for odd things. Some people love color. Some people have like the luxury look, right? Some people are more concerned with it having a navigation system on the inside. Some people are concerned with the rear, back rear stuff. I'm saying those things because I'm one of those people. I care about stuff like that. But those are the things that will ultimately satisfy you, right? And it makes you purchase certain things, and that's what I'm kind of getting to. So that's the part of their scorecard. Number of customers acquired. So in other words, you put a product out there, you're waiting for the customers to rate it, you know, on what they think about it. The truth is, how many customers will you get to rate it? Because honestly, if it's a bad product, you might have 500 people that want to say something about the fact that it's bad. But you might have 10 people that want to say something about the good stuff about the product. It just happens that way. That's how consumers are. On-time delivery. So in other words, if I go to Walmart on Memorial Drive every single Friday, and every single Friday I have been looking for Bounty with the dishwashing liquid inside of it and still can't find it, you are not a timely, you know, manufacturer. And frankly, if they're out of your product every time I go, I don't want to buy it anymore, right? And yeah, it's easy to go to another store and get it, but who wants to do that? That's the inconvenience. So why don't you have it in the store that I shop? Percent of sales from new products. Companies introduce new products every day, right? But to determine whether or not they're going to keep it is going to be based off of a consumer purchasing it, right? So we can produce it all day long, but is anybody going to actually purchase it? Time to fill orders. Again, that's a situation where with the supplier, if you provide a product and you can't get your stuff there on time when everybody else ships their stuff to the store to be sold, they probably don't want to deal with you because that's going to allow them or make them lose customers. Number of sales returned. Again, if you have a poor, sucky product, everybody will return it, right? And they're going to let you know that it sucks. They're going to tell you why they couldn't use it. Internally, why do we care about anything internally with the balanced scorecard? Defect rates. If you have a lot of defective items, which honestly comes from a lot of returns, right? What does that make the department do internally with defective products? How does that impact what's going on internally? Say it again, Miss was that Miss Taylor or Miss Harris? More so is wasting money. I'll tell you why. If you made 50 items and 25 were returned, now you got to make 25 more in addition to what you already had on your plate. You got to replace those 25, right? Which means more labor, more hours, and it takes a lot more money, right? Cost. The cost just increase with defective items. Second, cycle time. If it's taking you too long to get out one production run, then you're not being effective or efficient, which is costing the company money because that means you got some lazy hourly workers around you. To somebody, or you might even have a lazy management team because somebody's not getting the production out on time. Product cost, that's a management function. If management is budgeting for a certain amount of cost, but they're coming in way above what was budgeted, do you think the manager did their job? No. It's good for revenue to be way beyond what you budgeted, but it's not good for expenses to be up there too. Labor hours per order that ties into the effective and efficiency of production. If you don't have good productivity, then that means that you're gonna have a lot of people basically stealing what? Time, because they're not working according to their efficiency. Production days without an accident. There are some accidents that happen in the manufacturing arena. Machinery breaks. People break machinery. People cut their hands. People die, unfortunately. And so all of those things are, how do we protect ourselves against that? How do we avoid those types of mishaps? Innovation and learning. It's not just good enough for the customer to be satisfied. Who also has to be satisfied? Employees. Because if I'm not satisfied, I don't work. And if I don't work, that means you won't have any customers because there's no product to be produced. Right? It honestly does work that way. So employees have to be satisfied. Obviously, if employees are not satisfied, that's going to result in what? Them either quitting or you having to fire them because they refuse to do work. Right? Amount of money spent on training. These days, it is not unheard of. It is very common for companies to spill a lot of money into professional development because employees can get complacent. Employees can be ill trained, meaning lack of training. Employees can be, they can have some spot things going on, like you know this, but you don't know that. Or you know this, but you don't know that. So that's not going to allow you to do your job effectively. So what they have to do is put a lot of money into training you, right, to make sure that they, one, have a quality employee, two, make sure that the employee is there to do the things that need to be done so that the company can continue to operate. Number of new products. Yes, we know sometimes new products don't always sell the way that a company might want them to, but it doesn't mean that they should not produce new products. You can't be a tissue manufacturer and still be dealing with the same one-ply tissue that you've had since 1980 and think that you're going to sell. So you have to constantly do what? Reinvent, right, and innovate. Number of patents. Anything that you create new, you must have a patent for it. That's important. If you don't have a patent in place, anybody can steal your idea and you'll lose money, because I guarantee you if another company steals your idea, they're going to make more money than you because they're going to find a way to make it better than what you did, right? So it's important to make sure that there's balance there. And number of money spent on research, that's a big deal. It's the reason why companies do all these focus groups. It's the reason why companies send out all of these surveys. That money for research and development is to make sure that their current existing product stays in place and sells, and also anything new that they want to bring out sales. Think about, perfect example, you know, the soda market is just, everybody sells some type of soda, whatever brand, right? But the major people are who? Pepsi, Coke, right? The reason why they continue to remain one of the top Fortune 500 companies is because they put a lot of money into research on how to make their products better and also make better new products. Think about all the stuff over the years that those sort of companies have put out there for people to try and then yanked it off the market because it didn't work. But it didn't make them really lose a lot either, right? Look at the potato chip company. Who is it? Frito-Lay or Lay's or whatever they're called. That whole campaign they did with develop a new flavor, all they had to do was spend a little money to put it out there to consumers, to get consumers interested. Oh, you can win $5,000 if we pick your, you know, potato chip mix. And they came up with some nasty stuff, like cinnamon something on a potato chip, wasabi. It was a lot of different stuff. But that's what we mean by innovation and research and development. They basically said, instead of us spending money to try a couple of flavors, put it out there to the consumer. They know what they like to taste in a potato chip. And there are some people that like some odd flavors, like sriracha sauce and stuff like that. Like you would never think that would be on a potato chip, right? But they left it up to the consumer to choose And all they had to do was spend money just basically campaigning it and putting it out there, advertising it for people to do, and they flocked to it. And they ended up producing 3 new flavors. So they saved money there. Financial, it's pretty cut and clear. We always want a net income and not a net what? Loss. We always want a return on any investment because that would defeat the purpose of investment, right? We must always have revenue and sales growth, otherwise we would not be in business. Cash flow has to be in place because we still have daily operating things that happen, such as employees working, such as supplies needed, raw materials to be purchased, production runs, etc. Residual income so that we may continue to do what? Invest. And stock price. Why is stock price on there?
If the stock price is up, everybody think the company is a good company.
Right.
Management is good.
Stock price up, it means that we're doing something right, right? Stock price down, not so much, right? Look at the bottom exhibit 24.22. Check out success. Now, clearly this is coming from a retail perspective, but check out success. Actual 62%. What do the green arrows mean?
Yeah, exceeding
Exceeding the goal, right? Orders returned 2.2%. What does the yellow mean?
just meeting the goal.
Borderline, barely meeting, right? Customer satisfaction rating 9.5. The arrow, the green arrow means that you're exceeding customer satisfaction. Number of customer complaints 142. Red means what? You are totally under the goal. Not good. You're not meeting the goal. You're nowhere near the goal, and that's a problem, right? Okay. As far as problems are concerned, we will go over, because you'll find if you've done the homework already, and Ms. Davis said that she already did, it's relatively easy. But let's do quick study 24-4. You can just mark them. Quick study 24-5, quick study 24-6, and quick study 24-7. So quick study 24-4 through quick study 24-7 is what we're going to do. Starting with quick study 24-4. When is your homework due for this?
22nd of
Next week?
yeah.
Okay.
Next Wednesday.
Okay. Use the information in the following table to compute each department's contribution to overhead, both in dollars and as a percent. Which department contributes the largest dollar amount to total overhead? Which contributes the highest percent as a percent of sales? Round percents to 1 decimal. So we got 3 departments, right? We got Department A, B, and C. And what are we trying to, first we're trying to find the contribution to overhead, right? In dollars. And what are we starting with? In dollars.
We're gonna subtract the total expense of the gross profit.
You're going to subtract direct expenses from gross profit. And so let's write that here. Subtract, well, you want to do gross profit, subtract expenses, right? And for Department A, what do we have? How much for gross profit?
18,860.
And we need to subtract out how much for expenses?
3,660.
How much is it?
16,165.
Okay. Department B, what's the gross profit?
76,360.
How much are the expenses?
37,060.
What's the contribution to overhead?
1,000.
Department C, what's the gross profit?
34,440.
Expenses?
7,386.
What's the contribution to overhead?
27,000.
All right, now we gotta find the contribution as a percent of sales.
Overhead 96.
Now, what are we gonna do to find it as a percent?
You got the overhead by yourself.
Take the overhead by sales and do what with it?
Divide.
Divided by?
3,000.
What's the amount called?
What's that, Martha?
What is your 53,000?
Sales.
What are you dividing this amount by?
By the contribution overhead.
So that's what I'm getting to. Contribution overhead in sales dollars divided by sales. How much is it for Department A? The contribution overhead is here, right? So you just bring it down, 155 divided by 53,000, which gives us what? 28.6%. Department B, bring this down, 39,240 divided by 180,000. What's the percent?
21.8.
21.8%. Department C, bring it down, 27,054 divided by how much in sales?
84,000.
Gives us what percent?
32.2%.
32.2%. Good. So what does this tell you by looking at these numbers?
Which one maybe?
Who contributes the highest dollar amount?
Department C.
What? B. Y'all see those numbers up there? Who contributes the most in dollars?
Or in dollars, Department B.
Department B is in boy. Who contributes the most, the highest contribution percentage?
Department C.
C. Department C. How does that happen? How does that happen? And you can see it from just looking at it. Department B contributed the most in dollars. Why? Their gross profit well exceeded their expenses, as opposed to companies of Department C having the highest percent of sales contribution. The reason they had the highest percent of sales contribution is because their sales were much higher than the other two departments, right? Let's do quick study 24-5. Compute return on assets for each of the divisions below, each as an investment center. Comment on the relative performance of each investment center. So we got 3 investment centers. Right? We got cameras and camcorders. We got phones and communication. And we have computers and accessories. Those are the three investment centers. And so how do we get ROI? What's the equation?
Divide the net by the average asset.
Net income divided by what?
Average asset.
Average asset. Equals ROI. So what was the net income for cameras and camcorders?
ROI or return on investment or return on capital.
Return on investment or investment of assets. Same thing. What's the net income for cameras and camcorders?
4,500,000.
4,500,000. What was the average asset?
19 million.
Which means they had an ROI percent of what?
22.5.
22.5%. Okay, good. Phones and communications. What was the net income?
1.5.
1,500,000. And what was the average asset?
12,500,000.
12,500,000. Which means that they had an ROI of 12%. Computers and accessories. What's the net income?
800,000.
800,000. And average asset?
10 million.
Which means they had an ROI of 8%. So looking at these numbers, what does this tell you? Clearly, they're the superior one, right? Cameras and camcorders. Because they yield the what? The highest. Well, no, the highest ROI. 22.5% just means that you're paying back at least, you're getting back at least 22.5% on your investment. And obviously, computers and accessories are performing relatively low, right? Because they're only getting back 8%, which is not good. Quick study 24-6, moving right along. (24-6) says, refer to the information in quick study 24-5, assume target income of 12% of average invested assets. Compute residual income. How do we compute residual income?
Investment center divided by net income minus the invested, the target amount.
So we're taking net income and we're subtracting what?
Target net income.
Target income, target net income. And that's going to give us our residual. What's the net income for cameras and camcorders? 4,500,000. What's the target net income? How are you going to find that? Because that's something that we did not discuss. You find
12%.
yes, 12% of what? Yes, you do.
Assets.
Of the asset,
Your your average asset. So average assets, and we can just do them here. Company A was 20 million. times 12%.
which is 200. What? 2,200,000.
You said 2,400,000, which means that our residual is how much? 4,500,000 minus 2,400,000.
2,100,000.
I said cameras, phones, and communication. What was their average assets?
1.5
Mm.
The average phone and communication, the average asset is 12,500,000.
12,500,000 times 12% is how much?
1.5 million.
All right. What was the net income for phones and communication?
1.5 million.
Was it? So that means that they had residual income of how much?
0. Nothing.
0. And then lastly, computer and accessories had average assets of how much?
10 million.
10 million times 12%, which gives us what?
1.2 million.
And what was their net income?
800,000.
800,000, which means we had residual income of what?
Negative 400,000.
That sucks. That means you owe money. Good. And last but not least, quick study 24-7. Yes, sir. It's in your book. We talked about it. Residual income, investment centers is the section you need to read in.
Look at 1,005.
So quick study 24-7. A company's shipping division and investment center has sales of 2,420,000, net income of 516,000. 516,000, and average invested assets of 2,250,000. Compute the division's profit margin and investment turnover. So, what is the equation for profit margin?
Average investment divided by
Net income divided by what?
Sales.
By sales. So, net income divided by sales equals profit margin. If that's the case, net income was 516,000 divided by how much in sales?
2,420,000.
2,420,000, which gives us a profit margin of how much?
21.3%.
21.3%. What about return on investments of assets? What's the equation? Net income, average assets. In this case, the net income is still 516,000 divided by what amount for average total assets? Gives us what ROI?
22.9.
22.9%. Lastly, investment turnover. What's the equation?
Sales divided by invested assets.
So sales divided by invested assets. What's the amounts? Sales obviously is looks like 2,420,000 divided by what?
2,250,000.
2,250,000, which gives us what?
1.08.
1.08. So what that means is it takes 1.08 times, right? Before what? The investment, you can get a return. All right. That's all I have for today. This lecture is going to be posted on the current page. Announcements in a few, and we'll go over the rest next week. All right. Ms. Harris and Ms. Taylor, you guys have a good night, a good week.